Retirement math used to be simple. Save, invest, earn 4% annually, live off the dividends. And now, what if I told you there's an ETF offering over a 120% yield right now? I know, it sounds like a clickbait headline, but it's real. It's called MSTY. And on paper, it's paying more in a year than your investment is even worth. So naturally, the question is, what's the catch? Because a number that high doesn't just walk in the front door without some baggage. There's always a trade-off. And in this case, that trade-off is buried deep in how this fund actually works. In this video, I'm going to break it down, what MSTY is, how it generates such massive income, and what a $10,000 investment in it could realistically become. I'll show you and John how it's built, where the yield comes from, what risks are baked into the strategy, and why some investors love it while others stay far away. And at the end, I'll reveal what the actual dividend yield can realistically maintain and how it can grow a $10,000 investment into a $650,000 portfolio while paying over $7,000 in monthly dividend income. So, is MSTY a passive income powerhouse or a ticking return of capital time bomb? Let's find out together. Let's start with what MSTY actually is, because it's not your typical dividend ETF. MSTY stands for the Yield Max MSTR Option Income Strategy ETF. It's designed to give you high monthly income by targeting MicroStrategy stock, better known by its ticker MSTR. But here's the twist, it doesn't actually own MSTR shares. Instead, it uses a strategy that mimics MSTR's price movements without holding the stock directly. This setup gives it the flexibility to generate income in a unique way, but we'll have more on that later. Unlike ETFs that earn money from company dividends, MSTY's payouts come from a strategy involving options. That's how it can offer massive yields, sometimes over 100% a year. But there's a trade-off. This approach limits how much MSTY can grow in value. It's not built for long-term appreciation. Instead, MSTY focuses on generating steady cash flow, even if it means missing out on big gains during market rallies. This setup makes MSTY very different from something like SCHD or VYM. It's not designed for long-term capital growth, but for monthly cash flow, even if that means giving up long-term compounding or stability. Alright, now that we know MSTY isn't your typical dividend ETF, let's look at how it actually pulls off these massive monthly payouts and why it's able to offer some of the highest yields you'll find anywhere. MSTY's whole income strategy comes down to two key moves. First, it builds what's called a synthetic long position in MicroStrategy stock, MSTR. Then it layers on a steady stream of covered call options over that exposure. That combo is what fuels the high monthly cash flow. Let's break it down. Instead of buying MSTR shares outright, MSTY uses options to mimic the movement of the stock. It does this by buying call options and selling put options, a setup that lets it behave like it owns MSTR without actually owning it. Think of it like a cheaper, more flexible way to pretend you own the stock. Stick with me here. Then on top of that synthetic position, MSTY turns around and sells call options. These are typically placed right at the current stock price or just above it. What happens here is simple. Investors pay MSTY for the right to buy MSTR at that price, and MSTY pockets that payment as income. This is where the real yield comes from. The strategy works best when MSTR moves sideways or just drifts upward. In that kind of market, MSTY keeps collecting premiums without losing too much upside. But if MSTR suddenly skyrockets, those sold calls get exercised, which means MSTY has to give up its exposure right at the strike price. So in plain English, it misses out on any extra gains above that level. The upside is capped. On the flip side, if MSTR drops hard, MSTY still holds that synthetic position, so it takes the hit. And during times when markets are calm and volatility is low, it earns less from selling options, which means smaller payouts too. To support the whole setup, MSTY keeps a base of US Treasuries and cash. These aren't exciting, but they're stable. They help fund the option strategy and meet margin requirements, but they don't really help with income. And one important detail, MSTY is actively managed. There's a team behind the scenes, tweaking strike prices, adjusting positions, and reacting to market shifts. This isn't a set-it-and-forget-it index fund. It's more like a hands-on machine that needs constant tuning. So if we have to sum it up, MSTY is harvesting volatility. It's turning the wild swings of MSTR into a steady stream of monthly cash. Think of it like selling insurance on a roller coaster. The premiums are great when the ride is rough, but you better be prepared if the thing flies off the tracks. Now let's look at what this really means for investors, how those premiums turn into monthly checks, and why that payout might not be what it seems on the surface. We've already talked about how MSTY works under the hood, the synthetic exposure, the covered calls, the premiums, but now let's look at something equally important, the structure, because how this ETF is built plays a massive role in how it behaves over time. In crypto, they'd call it tokenomics, how a token flows, burns, inflates, or rewards. With ETFs like MSTY, it's more about the moving parts that define how income is generated, how it's paid out, and how the fund manages its capital. And this is where things start to separate hype from reality. MSTY isn't holding growth stocks or dividend kings like we've seen before. The majority of its portfolio sits in short-term US Treasuries and cash, ultra-safe assets that act as collateral for the fund's option strategy. They're not here to grow your money. They're just here to keep the machine running. Now, while the trading strategy is actively generating income, what happens after that income lands matters just as much. Most of MSTY's monthly distributions, no matter how large, are classified as return of capital. That's not a bonus. That's your own money being handed back to you in installments. It can feel great seeing $4.41 per share show up in your account, but behind the scenes, your initial investment is shrinking, and we're already seeing the effects. In just 6 months, MSTY's NAV, or net asset value, the value of each share, has dropped nearly 27%. That is a huge decline. Not because the strategy failed short-term, but because the fund is constantly selling itself off to sustain the yield. It's like living off your savings while calling that income. This is what people mean by yield erosion. The income is real, but it's unsustainable without fresh growth or rising prices behind it. And MSTY is not alone here. Other ETFs in the Yield Max family like YBTC, GOOY, and PYPY show the same trend, big yields but steadily falling NAVs. So while the payouts may grab headlines, the structural design reveals a trade-off that's easy to miss. You're not just investing in a high-yield product, you're investing in a fund that's carefully engineered to give you income first and everything else second. It's a strategy that trades long-term capital growth for short-term income. Also important, MSTY has no dividend growth. There's no compounding here. Just consistent withdrawals against the fund's value. So while the payout numbers sound incredible, it's vital to understand you're not building wealth here. You're extracting capital in the form of monthly income. Now, at the end of this video, I will show you and John the actual dividend yield MSTY can realistically maintain and how a $10,000 investment can grow into a $650,000 portfolio while paying over $7,000 in monthly dividend income. Stick around. Let's take a closer look at how MSTY has actually performed since launch, not just in terms of yield, but total value over time. MSTY launched in February 2024. In that short time, it's made headlines for its incredible income, but when we dig into the numbers, a very different picture emerges. First, the net asset value, NAV. As of mid-2025, MSTY's NAV has dropped over 27% in 6 months. That means if you bought in at the start of the year and never reinvested anything, your $10,000 investment would now be worth roughly $7,300 before taxes or fees. Now, yes, you would have received monthly payouts along the way, but remember, those payouts are largely return of capital. They don't increase your stake, they reduce your ownership. You're not reinvesting growth, you're recycling principal. That creates a dangerous illusion. It feels like passive income, but it's actually gradual liquidation. In terms of volatility, MSTY is extremely reactive to MicroStrategy's price swings, which itself is deeply tied to Bitcoin. So MSTY is indirectly influenced by crypto markets, even though it's structured as an ETF. When MSTR spikes, MSTY gets some lift, but is capped by its covered calls. When MSTR tanks, MSTY's NAV often drops harder because its synthetic exposure doesn't shield downside. This means MSTY's performance is asymmetric. It loses big in drawdowns but only gains modestly in rallies. That's a difficult dynamic to compound over the long term. If you look at MSTY's price chart, you'll see a consistent downtrend, and it's not alone. ETFs like YBIT, GOOY, and YMAX all show the same pattern: sky-high yields up front paired with long-term NAV erosion. So yes, MSTY is delivering cash, but it's doing so at the expense of its own structure. Now let's step back and look at MSTY from a broader market-based perspective. Where does it stand in terms of valuation, sentiment, and positioning compared to other income-focused ETFs? As of mid-2025, MSTY is trading just slightly below its net asset value with a discount of around 0.12%. That means the market price is pretty much aligned with the actual value of what the fund holds. It's not being bid up like crazy, but it's not getting totally ignored either. The pricing is tight, which shows the ETF is still on people's radar, but mostly because those big monthly payouts that continue to grab attention. And that rate is, on the surface, extraordinary. MSTY is paying out more than 120% annually in distributions, but again, as we've already uncovered, that's not all income. It's mostly return of capital, and that changes everything when we talk about valuation. So what are you actually buying with MSTY? You're getting exposure to a strategy, not a company. MSTY's structure doesn't grow earnings, assets, or book value. It operates more like a financial machine designed to convert volatility into yield with no focus on underlying asset growth. In terms of fundamental metrics, MSTY doesn't have a price-to-earnings ratio, forward earnings, or book value like a stock would. That's because it doesn't generate profits in a traditional sense. Instead, its valuation is tied to the price of MSTR, the volume and volatility of MSTR options, and the demand for high-yield payouts in the broader market. Compare that to more traditional ETFs like SCHD or even JEPI. Those funds hold real assets, pay dividends from actual cash flow, and trade near or below their NAV. MSTY is more like a yield amplifier, but amplifiers run hot, and over time, they wear down. So right now, MSTY isn't overpriced, but it's still risky. It's delivering income, sure, but it's not anchored by fundamentals. It's floating on yield hype. And the question is whether that's sustainable or just a short-term ride. Before showing you the final projection of a $10,000 investment in MSTY, let's first address the question, who is MSTY really for, and what risks are baked into the strategy? The first and probably biggest thing you need to know is that MSTY lives and dies by volatility. It's tied to MicroStrategy stock, which is basically a leveraged play on Bitcoin. When crypto makes a move, MSTR reacts, sometimes big, And because MSTY uses options to mirror MSTR, it gets pulled along for the ride. That leads to a strange dynamic. MSTY can lose big when MSTR drops, but it can't fully participate when MSTR soars. Investors get clipped at both ends. Limited gains, full exposure to losses. It's a strategy that performs best when markets move sideways, not when they surge or crash. Then there's NAV erosion. As we've covered, most of MSTY's distributions are return of capital. So if you're holding for income, you're also watching your investment shrink. Over time, that can severely limit compounding and even wipe out your initial capital if not carefully managed. There's also liquidity risk. While MSTY trades regularly, it's still a niche ETF. Big market moves or low demand can lead to wider bid-ask spreads, slippage, and unexpected losses when entering or exiting a position. And finally, there's strategy fatigue. Covered call ETFs are built for yield, but when volatility drops, so do the payouts. If MSTR enters a quiet phase or crypto sentiment fades, MSTY's premiums could dry up fast, and income could drop sharply. As for investor sentiment, it's mixed. Some love the monthly cash and reinvest it regularly. Others warn that MSTY is just selling itself back to you 1 month at a time. Ultimately, MSTY may suit short-term income seekers, but it's not built for wealth preservation or long-term financial growth. Now let's answer the big question. If you invest $10,000 into MSTY today, how far can it really take you? To figure that out, I've based the projections on a carefully chosen number, a 15% annual yield with monthly reinvestment. Not 120%, not some pie-in-the-sky number, but a rate that actually makes sense once you understand how MSTY works. So why 15%? Well, it's not a random guess. Earlier, we broke down MSTY's current payouts, over $4.40 per share per month. That's huge. But we also saw that most of that cash isn't from profit, it's return of capital. You're not collecting interest on growth, you're getting pieces of your investment back. Combine that with evidence from other yield max ETFs like YBIT, GOOY, and PYPY, and a clearer pattern appears. These funds start strong, but can't sustain double or triple-digit yields for long. Options premiums drop, volatility cools, income dries up. Taking all this into account, we landed on 15% as a number that reflects MSTY's short-term firepower while still acknowledging long-term decay. Aggressive? Yes. Unrealistic? No. So what does this look like in practice? With 15% annualized returns and no assumed share price appreciation, a $10,000 investment today would grow to $11,500 after the first year. After 10 years, that number climbs to $40,456. After 20 years, it's $163,665. And by year 30, it'll be valued at around $662,118. These results are based on a simple idea: take every monthly dividend and reinvest it. No compounding from share price growth, no dividend increases. And here's what that means for your future cash flow. By year 30, you'd be pulling in $86,363 annually, or around $7,197 per month in dividends. So now that you've seen the projections, what's the final verdict? Would I personally invest in MSTY for the long haul? Not likely. But as a short-term income tool, maybe. Here's the thing, if you reinvest consistently and stay disciplined, MSTY could grow your $10,000 into over $660,000 in 30 years, with nearly $7,200 a month in dividends. That's powerful, but only if everything lines up just right. Because this isn't wealth building, it's capital extraction, structured payouts backed by volatility and return of capital. There's no compounding, no business growth, no long-term foundation like you'd get with something like SCHD. MSTY shines when you treat it as a targeted income play, not your portfolio's backbone. If you're active, aware, and know what you're doing, it can deliver real monthly cash, but if you're hands-off, it can quietly eat away at your principal. So it's not a no, it's a know what you're doing. Personally, I'd consider MSTY for targeted income, not for portfolio core. Used wisely, it's a powerful yield machine. Used blindly, it's just a leaking faucet. And if you want monthly income without the erosion, click the video on the screen to find out how to turn a $10,000 investment into a $3.5 million portfolio using ETFs.